consumer's still strong. Their balance sheet's in good shape. They're spending 10% more than pre-COVID. They have more in their checking account. Companies are in good shape.
Consumer has still pretty strong balance sheets. They're dipping into savings, but we're less worried on the credit risk side. Just the vulnerabilities you normally expect heading into slower economic growth don't exist at the moment.
Welcome back. Bank of America CEO Brian Moynihan tells me spending remains strong among consumers and that a recession may not be imminent. Take a listen.
Nice to be with you again, and my teammates produced a great quarter again, and I thank them for that. But I think if you're talking about what we saw at our customers in terms of consumer spending, for the third quarter of 2022, the consumers spent about 10% more than they did in the third quarter of 2021. So 2022, third quarter, 10% over through third.
Sure. The simple fact of the matter is we're seeing continued strong consumer demand for our products and our brands.
The consumer definitely is still shopping, and they love products that are great value, quality products that last. And I'm very pleased, because we're in a business that is more resilient because people love their homes. I mean, people shopped a lot in the pandemic. We've been talking about that, yeah. But the truth is, their homes are their biggest asset.
Of last year's numbers, Sarah, I think was quite extraordinary. It just shows you that the consumer has money to spend and is willing to spend, and they certainly showed that in these last several weeks.
How's the consumer holding up right now?
The consumer is holding up. As we came out of 2022, we saw broad-based consumer resilience. Yes, there are pockets of problems, whether they be countries or consumers with less income, but broadly speaking, the consumer is still doing well.
If retail sales is a canary in a coal mine, that canary just choked and fell off its perch because retail sales were pretty bad during the month of December. Surprisingly bad, down 1.1% more than forecast. The control group, which is what goes into GDP, even worse, down 0.7%. You look at PPI, it comes in down. Inflation really seems to be falling, and the core for PPI also sequentially lower. So the Fed likes to see the second two numbers, the first two, not what they've been expecting. Here's why we saw a big drop in retail sales. Car sales, we knew were down 1.2%, not as bad as November, but still down. And gasoline prices really fell. Now, the interesting thing here is that has a big effect on retail sales, but gasoline prices have started to go up again. Remember, retail sales denominated in dollar volume. Grocery prices falling a little bit, so grocery sales flat. Look at what happened to department stores. Didn't anybody go out and spend money for the holidays on gifts? Non-store retailers also suffering, also a bit of a surprise. Amazon maybe not doing as well as people thought. Eating and drinking places, the ultimate discretionary, down 0.9. People stopped going out, at least in the month of December, it appears.
Because I'm all out of money!
All right. Today is Wednesday, the 18th of January. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's start with the breaking news. The chairman of the Fed, Jerome Powell, caught the thing. Now, the good news is he's on his, 7th booster or something, so he should be okay, right? Anyways, as a market bear, I say since Jerome Powell is still a hawk, we wish him a speedy recovery. But if he becomes a dove, then, well, good luck. Anyways, what's going on with the market today? Ooh, what a beating. What a trap. We opened up gapping higher, soft landing, optimism, it's over. The Fed is going to do this, going to do that. You log into your broker's account, you buy, you go all in. The perma bears were wrong. The Maverick of Wall Street is wrong. He doesn't know what he's talking about. And then 2 hours later, you're crying and you're talking to your therapist already. Because the headline reads, Unbound by the 2022 stock meltdown. More younger investors are ready to put money back to work, baby. They're all in. They're not scared of the bear market. They're not scared of Jerome Powell. I mean, Jerome Powell, who cares, right? He got the thing. He's gonna go. The hawk is dead. So we're gonna go all in. And the number one theory behind the all-in crowd, buy, is the fact that inflation is going down. We told you in this channel repeatedly, it's really important whether inflation is going down for the good reasons or the bad ones. The good reasons, for example, demand remains intact, but magically supply increases all of a sudden. The bad reasons, inflation goes down because of a recession. And today we got some good news, or shall we say bad news, depends. The headline reads, wholesale inflation in the US slowed further in December to 6.2%. Yay! Inflation is dying, it's going down, it's over. My professor from Wharton says it's over. And I have to say that, otherwise I might get an F, because the good professor has an ego. And if you don't agree with him, you're not getting an A. But the problem is inflation cooling down for the good reasons or the bad ones? Because what we're getting is more bad news after bad news after bad news. An update on the tsunami of layoffs. Today we got the confirmation. Microsoft is laying off 11,000 employees. So when we talk about inflation going down, you have these thousands and thousands of employees who now lost their purchasing power. Now that is demand being extracted out of the economy. No wonder why prices go down. No wonder why when the Fed raises rates and makes economic conditions tight, folks cannot spend more. And the end result of that is inflation going down. Duh. But the main question is the consumer just backing off because they're waiting for better rates, for example? Well, that doesn't solve the problem because that means that inflation goes down, but once the Fed backs off, the underlying conditions of inflation are still here because the consumer will go back and splurge once again in the economy, and that causes a revival of inflation. The Fed knows that, and they know that the only remedy to end inflation once and for all is by resetting the cycle, aka creating, keyword, creating a recession. They're not going to tell you that. They can't go out and tell you that, but this is exactly what they're doing. And today we got absolutely disastrous piece of news. And this piece of news was behind the stock market plummeting big time. While initially the stock market shot up higher in reaction to the PPI moving down, we also got retail sales, and they went down big time in December. Now initially the market looked at this as, oh, good news. It means that the job is done, the Fed is going to ease. This is the junkie mentality where the market is an addict to the Fed. But today we have witnessed something really, really important. A seismic shift in the mentality. The market finally realized that, whoops, wait a minute here. If retail sales plummeted down big time in the hottest shopping season of the year, is that really good news? Because that's recessionary. And are we now celebrating recession because the Fed is going to back off? How is that going to solve the problem? How is that going to solve the problem of corporate earnings? When the consumer is annihilated, who's going to substitute consumer spending, which is the main source of corporate earnings? The Fed can't print corporate earnings. The consumer has to be healthy, and the consumer is far from being healthy, despite what the satanic cult of Davos is saying right now. Today, it was a massive shock, a wake-up call, a reality check. Let's talk about it, ladies and gentlemen. Here it is. In focus tonight. The collapse of the U.S. consumer. It's no longer a conspiracy theory. It's no longer, oh, Maverick, you're a perma bear. No. It's here. You're seeing it right before your eyes. As if you needed confirmation. All what you had to do is go out there and talk to folks. And I talk to folks all the time, especially here in the state of California. Everybody complains about the cost of living. Rents are out of control. The prices at the pump are skyrocketing. The prices at the grocery store, unbelievable. Utility bills, shocking. The consumer is not doing good. But all what we hear from the media is, oh, the consumer is strong and healthy. The consumer continues to spend, yada, yada, yada. Today, all of that crap ended once and for all. The headline from the Journal reads, U.S. retail sales fell by 1.1% in December, shoppers faced higher interest rates, elevated inflation, and worries about economic slowdown late last year. Now, the most important element of all of this is the following. This was not the reading for March, April, July. This was the reading of the hottest shopping season of the year in December. And I believe once the market realized that was the shocker. That was the moment when the market realized, okay, this is bad. We can't put a lipstick on a pig anymore. U.S. consumers cut back on retail spending at the height of the holiday season, as consumers spent less on vehicles, in popular gift categories, and furniture. Have you seen furniture prices as of late? Absolute insanity for crap that is worth nothing out of China. Anyways, retail sales, a measure of purchases at stores, restaurants, and online, declined at seasonally adjusted rate of 1.1% in December from the prior month. This is according to the Commerce Department, of course. This was the biggest monthly decline of 2022 and marked the second consecutive month of decline. November's retail sales, listen to this, were revised lower to a 1% drop. In other words, remember last year when they said, oh, November retail sales data is good. The consumer is still healthy and strong and they're doing fine. All of a sudden now, when nobody's paying attention, they revised the number to negative. All of this is cooking. And for all we know, this report could be actually worse than they're telling us. To begin with, look at this. Another decline, the second in a row. This doesn't look good at all. Down 1.1%, and the trend doesn't look good at all here. When we look at the different categories, here's just an illustration for you. A lot of categories went negative. These are categories that were surging back in the summer all the way to September of 22. Now they're dropping like a stone. When we look at the data, look at this. You look at retail and food services, down 1.1%. This is all month over month, by the way. Motor vehicles and parts, down 1.2%. Furniture, down 2.5%. Electronics, down 1.1%. Health and personal care stores, down 0.9%. Gasoline stations, down 4.6%. Clothing, down 0.3%. And then the most shocking one of them all, department stores. This is where you go during Christmas. This is where you go during the holiday season to shop. It is the hottest season of the year to these stores. Sales were down 6.6% month over month. Unbelievable. Even online stores. And you heard in the intro, the guy says maybe a bad sign for Amazon. Down 1.1%. Food services down 0.9%. We have seen some categories increasing month over month, but not by a lot. You got sporting goods up 0.1%. Building, garden, supplies, Home Depot, etc. That's up 0.3%, but that is just a blip against a tsunami of decline in retail sales across the board. So the next time you hear these CEOs and propagandists in the media saying, oh, the consumer is doing well, the cult at Davos with the private jets, shaming all of us for driving cars, regular cars, they're out of touch, out of mind. They keep saying, oh, the consumer is doing fine. And I say to the media, if you want to know what the consumer is doing, stop asking the CEOs. Go down there and ask the consumer, how do you feel in this economy? How do you feel about prices around you? Do you see inflation going down? Because all what we hear from the Wall Street types, from the media types is, oh, inflation is going down. Inflation is over, they say. You, the consumer, do you believe that inflation is over? The answer is absolutely not. Prices are rising across the board for the consumer in real life, not in the fantasy land. And the consumer is already stuck, by the way. They're paying rents. They can't get out of these leases. They're paying an arm and a leg in rents. They're paying an insane rate in auto loans, in credit card debt. We talked about how a quarter of Americans are behind on their utility bills. The consumer is buried deep, and this financial burden will take away their disposable income from being applied into the economy. Folks can't afford anymore to go out and dine, or go to bars, or go watch a movie, go on a vacation, go take a trip, regardless of what they're telling you. And the only silver lining here is they still have their jobs, the majority of them, but that's tick-tock. It's just a matter of time before they lose their jobs. And the other silver lining is they still have credit cards. The problem is they're tapping out on these credit cards. We're now seeing delinquencies rising higher, interest rates moving higher, consumer debt on credit cards surging rapidly. The combination of both is causing delinquencies. At some point, the consumer is going to tap out. At some point, the consumer is not going to be able to use their credit cards anymore. And once we get there, how the hell will the consumer stimulate the economy anymore? It doesn't take a genius to figure out that we're going to head into a recession either way, Fed or no Fed. Now notice the recession themes all over the place. It's not just retail sales. Today we got the Services Business Activities Index from the New York Fed, which went down by 21.4 versus 17.6 month over month. Employment down, prices paid down, capital spending down. And here's the catch. Wages ticked higher. So you have stagflation going on in the economy here, where the fundamentals of the economy deteriorating at a rapid rate while inflation sticks around. You can say, oh, 6.5% of the CPI inflation is dead. It's not dead. It's still 6.5% year on year. And we have major categories that continue to rise in price month over month. So all of this talk about inflation is over. You have no idea what you're talking about. Take, for example, the prices of eggs. And they continue to circle the story, the same old one of, oh, it's the avian flu. The chickens are dead. That's why eggs prices are moving higher. Is it really? Because eggs prices have quadrupled year on year. That's a breakfast staple. Americans are paying more for eggs. And eggs go into a lot of things, a lot of other products, which means prices are going higher across the board. At the grocery store, if the consumer is spending more at the grocery store, they have to cut spending elsewhere. That causes stagnation in the economy. We're seeing this happening as we speak right now. Matter of fact, eggs prices are rising so fast, so high. This Valentine's, you don't need to go to the jewelry store anymore. Just go to Kroger's, buy her an egg. There you go. That's love. And if she grabs the egg and smash it in your head, that's not my problem. That's your fault. But anyways, when we have an economy that is deteriorating at a rapid scale, the argument goes, oh, the Fed has to stop. What more does the Fed need to see to realize that if they continue, they're going to dip the economy from a recession into a depression? The fundamentals of the economy are collapsing. We got the New York Fed manufacturing survey yesterday. That was an absolute disaster. The PMIs, absolute disaster. The tsunami of layoffs, absolute disaster. And now retail sales, absolute disaster. So why isn't the Fed backing off? The answer is inflation. But I know what you're going to say. But Maverick, inflation is cooling. It's going down. Isn't it time for the Fed to at least ease or pause or do something rather than continuing with the hawkish rhetoric? My rebuttal, and I made a video about it, they cannot afford to watch the dollar collapsing. Every time we have talks about easing and pausing and pivoting, the dollar goes down. And as a result of that, commodities move higher. That is inflationary. The Fed knows that. The Fed knows that they have to continue to talk like this to rescue the dollar. Otherwise, inflation is never going to die. And therefore, today, from the St. Louis Fed, Fed President Jim Blaze came out and he lit the market on fire. He gave you the dovish branch by saying that prospects of the U.S. economic soft landing have improved markedly. However, in the same interview, Mr. Bullard also said, your calls. No, I'm kidding. He actually said that U.S. interest rates have to rise further to ensure that inflationary pressures recede. Now, James Bullard is not being honest with you here. He has to say that they have to keep interest rates as high as possible for as long as possible to fluff up the US dollar. Otherwise, the dollar is going to collapse like you've never seen before. And in the interview with the Journal, Mr. Bullard said that his SEP rate projection for 23 would take the funds rate to 5.25% and 5.5% this year. Now, that's way higher than what the market is pricing in right now. The market is actually pricing in rate cuts. The delusion continues. But Bullard, and I believe that this is the statement that shocked the market, because by saying this, he slammed the door shut big time with any hopes that the Fed will cut rates anytime soon. He sounded open to raising rates by 50 basis points in the next meeting. Everybody says 25, but Bullard says he's going with 50. And now we have to wait and see what Jerome Powell is going to do once he's done with the thing. He likes the idea of taking out insurance, quote unquote, against developments that could keep inflation high. Now, Mr. Bullard likes other things to be high, but not inflation. In other words, Bullard says, I want to front load more. I don't want any prospects of inflation rebounding and moving higher again. Now, we can call this the red pill approach, meaning the hard medicine, take it now and be over with it. You can have the blue pill. You can have a milder approach, if you may. And this time around, it comes from Philly Fed President Harker, who said that rates should move higher a few more times. But he takes the approach that these few more times have to be 25 after 25 after 25. In other words, Harker wants to kill you by by few little stabs, little by little by little. On the other hand, Mr. Bullard wants to grab the samurai sword and slash your body in half right away. Boom, we're done with it. It's over. Which one you want to take? I'd take the Bullard approach, and the reason is, let's get it over with already. Get it out of the way, because the longer we wait, the more damage will happen to the economy. The economy's ability to absorb these interest rate hikes will diminish by time. So get it over with right now, instead of this wishy-washy approach of let's do 25 and wait and see, and then wait and see again, and then inflation pops higher all of a sudden, and we have to go and do 50, if not 75 again. Get it over with right now. And look, folks, there are reliable indicators that don't lie, just like Shakira's hips. One of them is the yield curve inversion. This is the worst inversion since the GFC. In other words, the bond market is saying this will be a major recession, worse than the GFC. Now, it's up to you if you want to fight this. To begin with, you're fighting the Fed. You're finding the data, you're finding reliable indicators, and you think somehow the market is just going to keep going higher. Somehow everybody else is wrong. Somehow every other reliable indicator that we've been using for years all of a sudden is wrong. It's different this time around. This is what the bulls are saying right now. Haven't we heard this before back in 2020, 2021, when the market was in an insane mania bubble? And we said this is unsustainable. This is the .com all over again. And the bulls at the time said, oh, but it is different this time around for fill in the blank reasons, and they were proven wrong. This time around, they say, oh, it's different this time. The yield curve inversion, that doesn't mean anything anymore. The Fed is bluffing. The indicators are wrong. Corporate earnings will be good. Corporate earnings will be good without the consumer. What are you smoking here? Anyhow, we're done with yet another lovely bedtime story. So let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average down big by 613.89 points, or a decline of 1.81%. The Nasdaq also in the red, down by 138.10 points, or a decline of 1.24%. The S&P, similar story here, down big by 62.11 points, or a decline of 1.56%. When we look at the sectors, all in the red, shame on all of them, no medals given today, and the laggards led by defensives, utilities, and energy. The action was brutal, everything was sold off, no mercy at all, no distinguishing between the good, the bad, and the ugly, all down. Some would argue maybe panic selling took place today, which could be a bear trap. I disagree, I say maybe we've seen panic selling. Actually, I agree, we have seen panic selling today. But what are the implications of this panic selling? The answer is a reality check to the narrative that has been going on since the year began. Of, oh, this is going to be a soft landing. Oh, the consumer is intact. Oh, the jobs market is still intact. All of these hopes face the reality check today. And therefore, when we look at the market breadth, absolutely horrific. The NYSE only 21% advancing versus 78% declining. The Nasdaq 27% declining versus 71% declining. Now, usually, not always, but usually when we have such exaggerated ratios to the downside, we get a bounce the following day. It doesn't mean a reversal, it doesn't mean that we're out of the woods, it just means that we might see some short covering in the short run. But to confirm whether that's going to happen or not, we have to look at the charts. We're going to do that in a minute, but before we do that, how about commodities? Believe it or not, commodities were rallying in the morning, with exception of natural gas, of course. But oil was in the green, so was gasoline, RBOB, so were metals and grains. But then came the reality check. And after that came the commentary from Bullard and Harker and the rest of them. And the action in the dollar was absolutely insane. It was up, it was down, it went up again. And this kind of volatility took a lot of momentum away from commodities, and therefore energy commodities down for the day. The WTI down by a little under 1%, Brent down by a little over 1.5%, gasoline RBOB down by a little over 1.25%, heating oil pretty much in the flat line. But look at natural gas, massive decline every time, every single time. Natural gas futures pop higher, they kill them right away. And I know some of you have the conspiracy theories of, oh, maybe JP Morgan is manipulating natural gas. I don't know if that is the case. All I know is we have a lot of catalysts, a lot of tailwinds for natural gas to move higher. And I tried to buy the dip at least twice recently, and I was wrong twice. Ate a pie in the face twice. Yet we have more and more fundamental news indicating natural gas should be higher. And I know what you're going to say. You're going to say, hey, Maverick, you're preaching to the choir. We know that natural gas should be higher, but it's not. I get it. but I have to present the data for you. For example, today we got the data from the EIA, and we got the projection for the Henry Hub for the year. And guess what? Even the EIA, even the government, is saying that natural gas prices should be higher than where they're trading at right now. Matter of fact, the EIA says that natural gas prices should average at $4.9 per MMBTU in 2023. We're way below that right now. And they also expect the prices will be the same in 2024. Now, you might read this and say, hey, this is a no-brainer. This is a buy. Even the EIA says that natural gas prices right now are underpriced. Matter of fact, the EIA says we forecast the Henry Hub price will average close to $5 per MMBTU in the first quarter of 2023. And that begs the question. Natural gas prices right now at $3.27 per MMBTU. There's a huge gap here. Is it a buy? The answer is, according to the EIA, yes. But so far, it hasn't been working. It is what it is. When it comes to softs, the gainers of the day led by cotton futures up by 2.35%. Then we have coffee futures up by 1.75%. The rest in the red, be it modestly in the red for OJ and lumber futures, and more notable declines for cocoa, a little under 1%, sugar losing about 1.4% for the day. When it comes to metals, down across the board, but the declines were led by silver, which went down by about 2%. On the other hand, gold and copper were pretty much on the flat line. When it comes to meats, we have a rebound here for live cattle futures worth about 2%, yet lean hogs futures down by about 1.5%. Now, when it comes to grains futures, initially they were trading higher before moving down after the commentary by Bullard or perhaps the reality check from retail sales, indicating that we have a recession on hand here. Now, you might have heard the conspiracy theories that we're going to see a major shock in Ukraine, something is going to happen, blowing up wheat facilities. I don't know anything about that. Now, if it does happen, that would be a tailwind for wheat to move higher. The question is it a strong enough of a tailwind to combat the major headwind of recession fears? That will be the question. Because for now, wheat is down around 1.5% for the day. And we also got declines for soybeans, soybean meal, corn, oats, canola futures, all in the red. Moving on to the big casino, the options market, what do we see here? Volumes moving higher. Are they moving higher in the right direction, aka the bullish direction, buying calls, or surging higher in favor of buying puts, because that signals a reversal of the rally we've seen year to date? The answer is we're seeing volume moving higher in favor of puts. Not a good sign for the bulls. And at number one, the hottest table as usual, Tesla, the souffle, with around 3.6 million contracts traded today. About 60.5% of those were puts. Major reversal here in Tesla. Amazon at number two with around 1.8 million contracts traded today. Once again, about 66.5% of those were puts, not calls. The rally in Amazon year to date was impressive, but the abysmal reading from retail sales pours cold water on this recent rally. And now folks are betting that Amazon will do a U-turn, move down again. At number three, Apple, with around 1.5 million contracts traded today. About 57% of those were calls. Puts. No calls here. No love for calls. Nobody wants to buy calls here. Anyways, on to the unusual activities that took place in the options market today. Notice the theme here. Folks are fading the rip in the recent winners year to date. They're betting against these names. The question becomes, are they going to bet for the losers year to date? Because today was a massacre for both the winners and the losers. Was it an overreaction for the losers? We're talking year to date, and are we going to see a correction of the overreaction tomorrow? Hold that thought. We're going to revisit it in the heat map analysis. But for now, what about the trade for the ticker META for Meta? A winner year to date, but now they're fading the rip. They're betting against the name, and somebody bought the 125 puts for the expiration date February 3rd, with expectations that Meta could lose more than 6% of its value by then. They paid around $4.20 a piece to enter this trade, all in all spending around $4.2 million. And then we have a strangled trade here for the SPY. Somebody's not sure. They know there is a big move coming. They're not sure if it's going to be up or down. So they're buying both calls and puts. In this case, they bought the 420 calls, and they also bought the 355 puts, all for the expiration date of March 3rd. And the expectations are that by the expiration date, the SPY could rally beyond 7% or move down beyond 9%. Now, they paid around $1 a piece for buying the 420 calls, and they paid around $1.50 a piece for buying the 355 puts. All in all, the entry cost is around $2.50 a piece, which brings the total all the way to $2.2 million. And then we have the trade for the ticker LYB for LyondellBasell. This is a chemical company out of Texas. A winner year to date. Somebody betting that this winner will continue to rally. Interesting. They bought the 100 calls for the expiration date, March 17th, with expectations that LYB could move higher and gain more than 10% by the expiration date. They paid around $1 a piece to enter this trade, all in all, spending around $700,000. And then we have the ticker USO, which is the United States Oil Fund, a proxy for oil anyways. Somebody's betting that we're going to see oil moving down, perhaps on recession fears. They bought the 66 puts for the expiration date, February 17th, with expectations that USO could move down and lose more than 5% of its value by then. They paid around $1.60 a piece to enter this trade, all in all, spending around $800,000. And then what about the trade for the ticker SPOT Spotify? Somebody sees the name moving higher, and they bought the 105 calls for the expiration date, February 17th, with expectations that the name could move higher and gain more than 13% by the expiration date. They paid around $2.50 a piece to enter this trade, all in all, spending around $1.3 million. And last but not least, what about the ticker CWH for Camping World? This is an RV company, and the guy who owns it is a CNBC personality. I forgot what the show is called, but anyhow, somebody's bidding against the name. Now, the name is a year-to-date winner, no surprise here. And I would think in a recession you want to own RV stocks, since a lot of Americans are going to lose their homes. Maybe RVs will be the new home, the new American dream. But anyways, somebody sees the name moving down. They bought the 22 puts for the expiration date, March 17th, with expectations the name could move down and lose more than 7.5% of its value by then. They paid around $1.50 a piece to enter this trade, all in all, spending around $800,000. On to the heat map analysis. What do we see here? What we see is a sea of red, indiscriminate selling here, which brings up the conversation whether this was panic selling or not. To answer this question, we have to comb through the losers. Maybe it was panic selling in certain corners of the map, but perhaps it's not panic selling. Perhaps it is legitimate selling, justified selling in other corners. For example, I'm just picking up on Meta here. If the consumer is deteriorating and their purchasing power is moving down rapidly and the economy is heading into a recession, do you really think that the ad business will do good? What is the point of companies advertising right now when the consumer is running out of cash? So maybe the recent rally in Meta is not reasonable. Maybe the U-turn that we saw today and we're about to see in the days to come is the proper reaction. On the other hand, is the sell-off in names of necessities such as Verizon, for example, justified or not? Will the consumer, now that they're weak, cancel their phone subscription? Highly doubtful. This is a necessity. Likewise, when we look at the different names in consumer defensives, be it Coca-Cola, be it PepsiCo, be it in the food packaging names such as Kellogg's, Kraft, Smucker, was the massive sell-off justified or not? The answer to this question is two-sided. Number one, will the consumer cut spending on these necessities? Will the consumer cut down spending on buying cereal, bread, cheese, eggs, etc.? Number two, now that inflation is going down, will the pricing power for these companies hold? Most importantly, will expenses for these companies fall faster than their pricing power? If that's the case, then the dip in these names worthy of buying. But if the answer is no, then these names will go down further. So keep an eye on how the map is going to change tomorrow. Keep an eye on what traders are going to pick up tomorrow. Are we going to see the rotation out of growth back into value? Very important thing to keep an eye on. Now, when we talk about corporate news, let's talk about Citigroup, which has been a disaster for years now, and this is perhaps a leading indicator to mass layoffs in Citi. The CEO now says, hey, the flexible work and home policy, that's a no-go, because if your productivity dips, and who knows what that even means, we're going to summon you to come back to the office as a punishment. My hunch is this is a trap, just like Goldman Sachs. They're going to say, oh, we just need you in the office because your productivity went down. You come to the office, you realize that, hey, you just lost your job. Goodbye. And then we have another recessionary piece of news regarding advertising, or it could be just a backlash against Twitter. You tell me. Because the headline reads, over 500 advertisers have paused spending on Twitter. Now, does that mean that the ad business all in all is moving down? If that is the case, bad news for Meta, bad news for Snapchat, bad news for Google. All of these names become a short. But if this is a specific case for Twitter, does that mean that Meta is out of the woods? Does that mean that Snapchat and Google and the rest of them out of the wood? I doubt it. I think this is the perfect excuse for these advertisers to cut spending. They're not going to tell you we're cutting spending because we're running out of cash. They're not going to cut spending and say, hey, we're doing so because the consumer looks really bad. The excuse to cover all of this is to say, oh, we don't like Twitter anymore. Elon Musk, you know the story. Now, when it comes to the heat map for the ETFs, a massacre across the board. Everything is down. Tech down, oil down, gas down, healthcare down, utilities, staples, banks, everything is down. Value down, growth down, nothing is in the green. With the exception of the inverse indices and bonds. Fixed income moving higher, that's recessionary. See, money doesn't just disappear in a black hole. Money doesn't come out of stocks and disappear. It has to go somewhere. Either it's going to go on the sidelines as cash, or in this case, in today's case, a lot of that cash moved into fixed income. That's recessionary. That's the market saying, we don't trust anything here. We're not even trusting value stocks. We're not even trusting oil stocks. We're not trusting anything. We're only trusting the ultra safety in bonds and fixed income. Now, the question becomes, how long will this sentiment stay? It's not going to stay forever. We're going to get good earnings from companies. Believe it or not, we're also going to get good pieces of data coming. With that being said, that doesn't mean that the recession is going to go and disappear all of a sudden. But today's reaction was kind of panicky. And I say it's a little too early to panic like this. So my hunch is we will see money coming out of bonds soon. That could be tomorrow. That could be next week. Who knows? And money is going to rotate into certain sectors of the stock market. Again, it's really critical and imperative to watch where the money is going to flow. Is it going to go back into growth? What will be the catalyst for such a thing to happen? I don't see any at all. But will the money rotate back into value stocks? This is what I'm watching for. Let's move on and do some charts and then wrap it up. And we begin with the SPY, the S&P 500. Now, folks, yesterday and today I said on Twitter, the important numbers, SPY 398 and Qs 280, demand some respect. These are important numbers, both as support and resistance. You can't just pass them without paying respect. Now, what does that mean? What does respect mean? It means either the chart has to spend a little more time consolidating around these numbers, 398 in the SPY, 280 in the Qs, or the charts need to move down, asking for support. Cracking above these numbers requires a lot of support. The question is, after the retail sales data that we got today, will folks waiting on the sidelines step in and offer this support? My hunch is not immediately. It's going to take something. It's going to take a commentary from the Fed. It's going to take a piece of macro data. It's going to take earnings to motivate those waiting on the sidelines to hop in. If you asked me yesterday, if the chart moves down, will we find buyers and support to move higher again? My answer would be yes. But after today's retail sales data and the commentary by Bullard and Harker, I think a lot of folks waiting on the sidelines are now becoming terrified. And therefore, what happened today is we had a bear flag pattern consolidating at around 398. And my assessment was, down we go. We have to look for support downstairs. But the geniuses in the morning did the gap higher, gap and crap, of course, based on soft landing optimism. And soft landing optimism lasted for 5 minutes. And then down we go. In a big way. A big flush down, 398 is gone. The chart consolidates. The next support, 393.16. Couldn't find support over there, so it moved down. Now the chart is going to ask support at 391. Let's say 390 to close the gap below. If there is no support, down it goes all the way to 385. And here's the daily chart for the continuous contract for the S&P. Met the important resistance, couldn't make it, got rejected, and reversed. So we have a rejection and a reversal right now. Why do I say that? Because the chart lost the important support of 3,960. In other words, when we see the volume moving higher today, which could be the beginning of a series of volume increases, meaning more selling to come, when we see the RSI curling down in a big way, when we see the MACD losing momentum, all indicators say down we go to the next support. And the next support would be 3,855. Now, if the chart doesn't find the support there, then all of these hopes of the bear market ending will go out of the window, because cracking below 3,855 3,855, closing below this number on a weekly basis, will confirm that we're going to make lower lows in the pattern. So the bulls are not out of the woods yet, but they have to keep 3,855. When we look at the SPX, the cash index weekly chart, amazing, isn't it? Stopping exactly at the same trend line. Now in this case, in this chart, do we have a reversal? The answer is not quite. We have a rejection for now, but we don't have a reversal. We don't have a confirmation because the candle that we have so far for the week has yet to close below the lows last week's candle. If that happens, that would be the reversal, and the confirmation would be losing 3,800 as support. When we look at the Qs, 30 minutes chart, a similar story here. We talked about the importance of 280. Today, the algos, the traders did not pay attention. They were so consumed by the PPI, and they created a gap. And the gap ended up being a gap and crap. It got all the way to the next resistance at around 284.26. Couldn't make it. Came the reality check. We have a reversal, a move down, back to 280. Couldn't find support at 280, forming a bear flag, and then closing at the lows of the day. Now the problem in the Qs is we have some soft support between 269.29 and 280. But it is soft support. It's a bunch of gaps, bunch of rebounds, but nothing really major here, which means that the Qs is at the risk. I'm not saying it's going to happen. I'm saying in the worst case scenario in the pullback, we could see the Qs pulling back all the way to 269.29 before it finds support. And here's the daily chart for the continuous contract for the Qs. What we got for now, looking at the chart, is a rejection and a reversal because it closed below the lows of yesterday's candle. We have yet to have the confirmation. The confirmation would be another down day tomorrow. If that is the case, looking at the volume moving higher, looking at the RSI losing momentum along with the MACD, you put 2 and 2 together, the assumption becomes we go down in a retest to the June bottom, which stands at around 11,058.5. Can the bulls rebound tomorrow? The answer is yes. But if that confirmation comes, we're going back to the June bottom. What about the Russell 2000? The IWM 30 minutes chart, similar story here. We said if you played the rally, made some money, book some profits, take some chips off the table because all of these charts are becoming susceptible of a pullback. And today, while we got the gap in the morning, ended up being gap and crap. Couldn't make it on hold above 188. The chart went down to the gap. The gap couldn't hold. We have a flush down all the way to the end of the day. We have yet to see a retest of the next support at 183. So the assumption for now is, at least looking at this chart, it needs to find support somewhere. If we see a gap higher tomorrow, don't be fooled because that will be a technical reaction to oversold conditions on the shorter run charts. You need to see the IWM rebounding from a reliable support. And the most immediate one we have is 183, and then we'll take it from there. The dollar, the Dixie daily chart, unbelievable action today, up and down, up and down, up and down. And all in all, the dollar closed flattish for the day. It ran a retest to 103, couldn't make it. Now, does that mean that the dollar is going to go down from this point on? With the hawkish rhetoric from the Fed, watch out here, the dollar could stage a comeback. For example, when we look at the 30 minutes chart, look at this, we have a bull flag pattern. Now, if it does play, we have to wait out for the reaction of the chart around 103 this time around as resistance. If it crosses above, we see a retest and a move higher after that, then we know that the dollar staged a comeback. In that case, commodities will go down, including gold, including oil, and also including stocks. They will pull back big time. If we have a retest to 103 and the chart can't make it, and it moves down again, then we have a confirmation that we have to stick to the same playbook. The dollar is weak here, and instead of chasing stocks, we have to stick with commodities or commodities-related stocks. Speaking of, here's gold. Gold is pulling back, at least for now. One would argue that this is a bull flag pattern and higher it goes from this point on. Too early to say. For now, it went down in a retest to my number. This is not Fibonacci's number, 1895. The problem with gold is, you look at the RSI, you look at the MACD, more than not, the odds are for gold to move down, to experience some negative momentum. If that is the case, the pullback is not just going to get us to 1895. It should get us all the way to at least 1842. And if that is the case, when we see a rebound in the dollar, how bad will it get in UK oil Brent? The answer is, for now, oil is doing pretty good. It is holding 85. The problem is, if the dollar rebounds higher, we're going to see a pullback here. But so long as the pattern of higher lows still intact, oil bulls are not dead yet. Once the pattern is lost, and most importantly, 77 is lost, then we got a problem. Then we got a confirmation for the recession. Too early to say that for now. We have to wait and see whether today's reaction was an overreaction, at least in certain corners in commodities and stocks. The 10-year yield, what do we see here? To me, this is the most interesting chart of the day because so far until this point, every time the 10-year went down, this was bullish for stocks. Every time we see the 10-year moving down, the assumption is, oh, the Fed is pivoting, and that's good for technology and high multiple stocks. But today, we could be looking at the beginning of the recession theme, in which the 10-year goes down along with equities, because what the 10-year is saying right now, we look at the future, it doesn't look good. A matter of fact, every time the Fed talks hawkish from this point on, every time the Fed raises rates, you see the 10-year moving down. The geniuses on TV will look at this and say, oh, they're going to say the bond market is calling the Fed's bluff. The bond market is not buying what the Fed is saying. No. The bond market is actually buying what the Fed is saying. The bond market says if the Fed continues to raise rates, and maybe they have to, we're not saying any judgment about this. We're just saying if the Fed continues to raise rates at this point on, the probability for recession gets higher and higher and higher. And therefore, the 10-year goes down. So please pay attention to that because the media is not going to catch up to it until it's too late. TLT moving higher today. The question is, it's not at my number yet. We have to wait till 109.5. On to the VIX 4 hours chart. What do we see here? We talked about the bull flag pattern. We talked about how fast they're going to push the VIX higher once it cracks below 20. This is exactly what happened. Any manager, anybody with half a brain knows when the VIX goes below 20 in a bear market, you gotta buy some puts, you gotta book some profits here. This is exactly what happened. Now the VIX is above 20 again, and it has the momentum to re-challenge 21.83. That is resistance number 1. And then the next one would be 24.29. Apple, the big kahuna, 30 minutes. What's going on here? Yesterday, we talked about a bear flag pattern. We talked about how the chart has to respect the numbers. We talked about the negative divergence on the RSI. All indicators that the chart should be moving down. Yet we got the trap, the stupidity of the gap, the soft landing optimism. What do you know? It sucked a lot of bulls. It sucked a lot of mom and pops, unfortunately, who've been waiting on the sidelines, and they killed them right away. They took them behind the woodshed, and they shot them twice. Now the chart went down in a retest to 135.36, forming a bear flag pattern. Couldn't make it. It broke below it, and now we have to retest 134.37. My hunch is it might not hold. Tesla, the souffle, 30 minutes. What do we see here? It got us above 128.62. That's the good news. The bad news is Tesla also had a gap and crap, and now it is consolidating in a bear flag pattern of the important support of 128.62. Now, a gap and crap is a reliable reversal pattern, but do we have a confirmation in this chart? The answer is absolutely not. It closed above the important support of 128.62, unlike many other charts that violated the important support right away. So Tesla looking a little better here. But could we have the confirmation tomorrow if we have an ugly day all in all? Tesla could move down, closing some of these gaps below, but my number becomes 113. Closing below 113, bad news for Tesla. What about Bitcoin? Last but not least, tulips, pullback, a retest of 20,593 once again. I'd like it to go a little lower to see whether the ABC pattern will hold or not. We talked about 18,500. It goes below that, there is no ABC pattern. So keep your eyes on Bitcoin. This could be the leading indicator, by the way. Whether what we got today was an overreaction, panic kind of selling. If Bitcoin rebounds from 19,000, 20,000, doesn't matter which point, so long as it is above 18,500. If it rebounds, if it recaptures 20,593.34, you got a confirmation that the risk-on rally will resume. Lastly, what do we have on the economic calendar tomorrow? We have a lot. We have the initial jobless claims. We have building permits and housing starts. We also have what it could be another disaster in the Philly Fed Manufacturing Index, along with a bunch of Fed zombies speaking this time around. We have Boston Fed President, a new one, Susan Collins, along with the Vice Chair, Madam Braindead, and the King of Doves, John Williams. If they all come out confirming what Bullard said, what Harker said, that yes, we see what's going on with retail sales, we see what's going on with the deterioration of the economy, but it doesn't matter. We have to keep the dollar propped up. That would be a major problem for the market. Now, what do we have in the earnings calendar? We have Procter & Gamble, Fastenal, Altacion, and Netflix, the most important one. And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Good night.
I'm gonna buy it. It's $2,400. Are you out of your mind? Come on, let's go.
I like to hang with you.